The wealth gap between the haves and the have-nots is growing wider. The growing wealth gap has led to demand for low-cost everyday items, and Dollar General has capitalized on this by providing easy-to-shop stores with low prices on frequently needed items like food, health, beauty, cleaning supplies, basic clothes, and houseware. It's headquartered in Tennessee and has over 19,000 stores in the US alone. It's become a giant, but is it worth buying? Now, it's my goal to beat the S&P 500 every year. I've made Dollar General my first acquisition of 2024, and I'm going to show you why. We will track the acquisitions in real time in eToro. Remember, I've limited myself to only companies on eToro, no commodities, no crypto, no currencies, companies only. So why Dollar General? So we can start to answer this question by looking at the first intrinsic valuation, that of the asset value of the equity. Here, we seek to understand what the business owns and what the business owes, and take a stab at reappraising some of the assets and liabilities to find their true economic value. Now, for Dollar General, we don't need to dig very far to understand the market is not valuing the company based on what it owns. The share price makes the value of the company well over and above the asset value. Even if I try to go through and add back the intangible assets like brand and workforce, we simply don't get near the market capitalization of Dollar General as it stands today. So we move to the next intrinsic value, and that of the earnings power value. Here, we seek to understand what the company is worth by looking at the future earnings of Dollar General and discounting them through time to find what the business will produce in terms of cash flow over the lifetime of the company. Now, based on the latest accounts, I worked this out to have an intrinsic value of around $174 per share. It used to be higher a couple of years ago, but the cost of borrowing has gone up and the debt of Dollar General has made it vulnerable to increasing costs. Most recently, we have seen interest rates rise to 5% plus, and the share price has dived with that valuation. But I am of the thinking that it's been oversold. So let's work through the earnings power value of the equity calculation. We focus on the profit and loss account for the earnings power value. Let's break these key elements of the P&L down. So for the earnings power value of the equity, the most important element to focus on is the net operating profit after tax. So you can see here that the net operating profit after tax is growing to $2.578 billion for Dollar General at the end of the 2023 financial year. However, when calculating the earnings power value of the equity, it's important not to focus on one single year of the business, as that can be cyclical in nature. We tend to elevate the earnings in a particular year for a variety of reasons. This is why we focus on multiple years and smooth out the net operating profit after tax to build what's called sustainable earnings. So if I take the average net profit after tax for the last 3 years, we result in a position of $2.624 billion for Dollar General. And let's imagine for the moment that Dollar General doesn't grow, it doesn't shrink, and it will continue to earn $2.624 billion of net operating profit after tax for the lifetime of the company. But then we need to understand that the time value of money here. We also understand that the present value of those future cash flows is going to need to be discounted. So we take that $2.624 billion per year and we discount it in every year for the whole life cycle of the company. And once we have all those future discounted cash flows worked out, with some of those discounted cash flows into a single pot, which results in $56.181 billion. This is the earnings power value of Dollar General over the lifetime of the company. If you were to invest in Dollar General today, this would be your reward in terms of summation of cash inflow over the lifetime of the company. But we're not finished yet. Dollar General carries a small amount of cash on the balance sheet, so we add this back into our valuation. And more importantly, Dollar General is also carrying $17.661 billion of debt on their balance sheet, and this needs to be paid off. So in terms of valuation, we take the earnings power value of $56.181 billion, we add the cash, we take away the debt of $17.661 billion, and this results in an earnings power value of the equity of $38.902 billion. So how do I calculate how much we should be paying per share of this company? Well, we divide that earnings power value of the equity by the number of shares outstanding, and this leads us to a figure of about $174 per share based on the future earnings of Dollar General. This is the intrinsic value of the company. So let's see this visually. Here is the share price that is in nosedive since the cost of debt has gone up, and I've hypothesized that the valuation of the company has gone down as a result of the high debt of Dollar General, and therefore the company has been sold off by the markets. And there's an intrinsic value we just need to work out using the earnings power value of the equity. So we put in that single line at $174 per share. So this is essentially anything below this line of the earnings power value of the equity is in the buying zone. Now, in the interest of creating a margin of safety, I did not start buying this stock at $173 or $174. I do expect some growth. We can see that in the return on the invested capital for the business and the diligent investment of capital by the business. And I also have the opinion that there is some competitive advantage in the marketplace. So I've been buying this at around 25% below the intrinsic value indicated here. Again, my hypothesis is that the cost of capital, when that goes down and the market becomes more satisfied with the ability of Dollar General to repay its debt, I expect the share price to recover. Follow and subscribe to The Old Contrarian if you want to know how to value a business.